So what's the question again, Hart?
So this is coming from someone who doesn't have a house and doesn't have anything of an idea of how to purchase or what it is they want. But I'm looking to purchase the house of my dreams where I want to live. And instead of, purchasing it in San Antonio and then moving into Delaware someplace, I just want to be direct and go straight forward, straight at the house itself. I was curious to know what is the process like
Yeah.
going to start looking into it.
Yeah, absolutely, absolutely. So I'm gonna share with you what the process is, and then I'm gonna share with you how COVID impacted that. So before COVID, before, during COVID, and after COVID, the process is it's usually the same, right? So ideally, what the bank wants, the bank that's gonna finance you, if you're gonna put 3% down payment, which is the lowest you could probably go right now, 3.5% is another option, which is called FHA, Federal Housing Administration. It's an insurance. That's the easiest to be able to use, right? FHA 3.5% down payment. You could also do conventional 3% down payment, 5% down payment, or higher. So it's the down payment. The percentage of the down payment is based on the price. So in Santa Cruz, California, there are some properties that are very expensive because it's a beach type community. But the ones that are further out, they could be less expensive, more affordable, right? So whatever the price might be, you could start with 3% down payment, conventional, and higher, whatever amount you could save. But what the bank doesn't really want is that, let's say you put 3% down payment and then you're out of money. They want you to have some reserves, right? They don't want you to make a purchase and then you don't have any money, right? So ideally, you would want to have some reserves, right? So then we have to work on reserves plus down payment. But then the bank wants to make sure that you are employed for the last 24 months in an industry that it's likely to continue to have you employed. Because what COVID created is that it created unpredictability on some industries and created predictability in other industries. And it created an even stronger predictability in other industries. So they went to look at what your industry is, right? So if you're employed like a W-2 employee somewhere, they want to see 2 years stability of employment. And COVID now has really strengthened their uh, how they look at things. They want to make sure they can be employed for the next 24 months during COVID until it's gone or it disappears. So stability of employment and stability coming up to the next 2 years of employment, right? So it's reserves and down payment, stability of employment. Uh, Before COVID, 640 FICO was acceptable. It still is, but with some restrictions, 640, 670, 680. But right now, in order for you to get the best interest rate, really ideally, you want to be at 700 plus FICO. That's the ideal scenario. And when you have good FICO, oftentimes you have a lot of debt. Good FICO oftentimes means that you have the ability to incur debt and be able to pay it back. But having a lot of debt affects you in being able to qualify for a property. So, as an example, let's say you make, let's do low numbers for math purposes. Let's say you make $1,000 a month, but you have a car payment, you have a credit card payment, Home Depot payment, SunMatch credit card, so that you have, with all your payments combined, let's say you have $500 a month going out, and you make 1,000 a month. That means you're at 50% ratio on your debt to your income. So the bank wants to make sure that you're at 45% or less. Personally, when I'm having this conversation with clients, I try to always have clients have no debt. So if you have a lot of student loan debt, credit card debt, car loan debt, whatever it is, I rather we wait and you pay the whole debt off, or at least like pay as much as you can so you come into a purchase with very little debt. Unfortunately, sometimes people don't want to hear that and they're not interested. It's more about house. Okay, cool. So, I give my advice and my reasoning why, and then it's up to them to take it or not, right? And if you have everything that just described, and you're 45% debt to income ratio or less, and you qualify for a loan based on FICO, based on your stability of employment, and you still want to move ahead and buy a property, then go ahead. As long as you qualify, it's cool with me. So that's the process, right? And so then how the bank determines all of that, they look at your last 2 years taxes. They look at your last 90 days of bank statements from all types of bank statements, savings accounts, checking accounts, whatever type of account you have, retirement account, so that they could see your reserves, right? And then they look, and then they do what's called VOE, verification of employment, because not only, again, they want to make sure that you're employed and you've been employed for the last 2 years, but they want to see stability of employment for the next 24 months. And then they look at the credit report, because the credit report tells them how much debt you have, what do you owe, and then they calculate based on your income on your taxes, your check stubs versus your debt, and they'll be able to determine the to income ratio. So once they get to that ratio, then they'll tell you, yeah, cool, no problem, you qualify for this much. And then based on that, we start looking at properties. So let's say you qualify for $1 million, based on everything which is discussed, then we start looking at $1 million property value or less. And then once you find the right one, then you submit an offer, and then that will be once you're there. But to get there, these are the steps to take. Now, there's a couple of differences when you're W-2, because when you're W-2, we have to look at 2 years of employment, right? If you're employed by somebody, you get W-2s, you get a paycheck every 2 weeks or whatever the case might be. But where you're self-employed, you don't have checks like that, right? You don't get W-2s, you get 1099. So then how the bank verifies that you actually have a viable business, they look at your taxes for the last 2 years to ensure that you have an established self-employed business. And so they look at your industry. How is your industry going to be affected for the next 2 years with COVID? And if they find that your industry is good or it's thriving during these times, like many industries are, then yeah, you could be able to get a loan too, as long as your taxes show 2 years of self-employed. So oftentimes what ends up happening is that some people will say, but Carlos, I'm about to change jobs because this company is going to pay me more. Should I wait or should I buy a property now? Okay, so then considering all those rules, that you have to show proof of stability of employment for the last 2 years. So if you change jobs because you got a better pay, you should be able to qualify, right? But if you change industries, you no longer qualify because we don't know what kind of stability that new career is going to be. So the only objection to that, or the only caveat to that, is that if you're a plumber that makes $20 an hour and you go get a new job and another plumbing company that pays you $30 an hour, so it makes sense. You're upgrading within the same industry. You're not changing careers. But if you're a plumber and you're gonna go get paid more as an electrician, then that's where you get disqualified because that's an entirely new career that you haven't proven yourself for the last 2 years and much less employment stability. You see, so that's something to look at, right? So yeah, 2 years of the same line of work, you show proof by your taxes when you file your taxes.
Got it.
So yeah, that's how that works.
Got it. Thank you.